This is Nightly Business Report with Tyler Matheson and Sue Herrera.
We want tax reform that is pro-growth, pro-jobs, pro-worker, pro-family, and yes, tax reform that is pro-American.
The president proposes one of the most sweeping overhauls of our tax system in decades. What could it mean for you? Stalled market, home sales weaken again, and now a leading expert does not expect improvement anytime soon. Louisville slugged. Well-known coach Rick Pitino is put on leave in response to a bribery investigation that's engulfing college basketball. Those stories and more tonight on Nightly Business Report for Wednesday, September 27th. Good evening, everyone. I'm Sue Herrera. Tyler Matheson is on assignment tonight. Investors have been waiting for Republicans to officially put forth their tax reform plan today. They got it. Months in the making, the president calls it a revolutionary change to the nation's tax code. The blueprint calls for drastically lower rates for business, fewer income tax brackets for individuals, and a much larger standard deduction, among other things. But as Ilan Mui reports from Washington, a lot of details still need to be filled in.
President Trump using a receptive crowd in Indiana to sell his tax framework as a salve for the middle class.
We're doing everything we can to reduce the tax burden on you and your family. By eliminating tax breaks and loopholes, we will ensure that the benefits are focused on the middle class, the working men and women, not the highest income earners.
The plan still leaves many unresolved questions, but it's got a lot for U.S. businesses. The corporate rate will go down to 20%. Pass-through businesses would get a 25% rate. The plan also allows for at least 5 years of full and immediate expensing. One of the trade-offs, though, is that the ability to deduct interest would be partially limited, though there's no detail on what that means. The plan does preserve two provisions that are important to businesses, the R&D tax credit and the low-income housing credit. But the deduction for domestic production, which is important for manufacturers, that one gets the axe. Under this framework, the U.S. would move to a territorial tax system. There would be two rates for money that's brought back, and the plan doesn't specify what those are, but the rate for illiquid assets would be lower than the one for cash. On Capitol Hill, leaders said the focus is on fairness and simplicity.
Today, we are taking the next step to liberate Americans from our broken tax code. This unified framework delivers a new tax code that is simple, that is fair, that is pro-growth and pro-family.
On the individual side, the new streamlined rates would be 12%, 25%, and 35%. But lawmakers do have a green light to add a fourth rate to the top. The alternative minimum tax, the estate tax, and the transfer tax, all of those would go away. The only personal deductions that the plan promises to keep are the ones for mortgage interest and for charitable donations. Opposition to this plan is already mounting. Senator Ron Wyden, the ranking member of the Senate Finance Committee, called this a sweetheart deal for powerful CEOs, and he said it violates Trump's promise that the wealthy would not benefit. For Nightly Business Report, I'm Ilan Mui in Washington.
Mark Stieber joins us now to talk more about the proposed tax changes and what it could mean for you. He is the Chief Tax Officer at Jackson Hewitt. Mark, welcome. Nice to have you here.
Thank you. Good to be here. Great topic to talk about.
I bet, especially from your perspective. I know we don't know all the details, but what is your big takeaway from this particular proposal for the average person?
Well, you know, I've heard a lot of different opinions today on it benefits one group or another group. What I would tell you is there's a lot in it for a lot of taxpayers. There's a lot of breaks in for the low and moderate and medium income taxpayers, the doubling of the standard deduction, the increased child tax credit, other credits for non-dependents that have been proposed, a reinforcement of some of the retirement and education benefits were mentioned. But there's also some benefits for the high income, so those are in there as well. So my one big takeaway is there's a lot in there, and it'll be interesting to see where it all gets sorted out as the debates start and the negotiations start. But it's a good platform to start with. A lot in the proposal.
It sounds like it. You know, some of the states, I think, are going to be pushing back because state and local taxes may be eliminated under this particular proposal. What's your opinion on that? Because a lot of people do itemize and take that particular deduction. Do some of the other aspects of this plan as it's proposed make up for that lack of deduction?
Well, you know, that's a great question, and it certainly did propose to eliminate some of the itemized deductions. I saw that they were going to hold on to the charity and to the mortgage,
right,
but the others are up for negotiation or possible elimination. And that will certainly affect, you know, those people who live in states with a high income tax, or any state income tax for that matter. But California and New York have been particularly loud about not liking that particular provision. So again, it'll be interesting to see what ultimately gets passed, but that's on the side that ultimately, you know, will raise taxes for some taxpayers to offset some of those cuts for the others.
Right. What do you think is going to be, for the average individual, the most important part of this plan?
Well, you know, they talk about tax simplification and that doubling of the standard deduction to $24,000, and then the removal of the 7 income tax brackets down to 3 will certainly be something to watch. In particular, I'm watching the increased child tax credit. A lot of clients at Jackson Hewitt take advantage of that, and so that's one that we're particularly sensitive to because it touches a lot of moderate and middle income taxpayers. So if they increase the child credit, they add a new credit for non-dependents. Those are two that taxpayers should be particularly sensitive to, because that could put immediate money right into your pocket if those provisions pass.
Very quickly, from your perspective and with what we know of this proposal, does it make your job easier or harder?
Well, it makes my job better because we get to provide all those benefits to all working Americans, and this certainly has a lot more in it than they're taking away from most people. So I don't know that it hits the goal of simplification as much as you'd like, but it certainly does provide tax benefits, which should ease the tax burden for most Americans as I see it currently proposed.
All right. Thanks, Mark. Really appreciate it.
Great to be here.
Mark
Thank you.
Stever with Jackson Hewitt. Meantime, on Wall Street, a rise in bank stocks helped lift the broader market as investors continue to believe that interest rates are headed higher. Just last week, the central bank signaled that it plans to gradually raise rates. And yesterday, the Fed Chair Janet Yellen reiterated those projections. That sent the bank ETF, called the XLF, to a 10-year high and helped the major averages. The Dow Jones Industrial Average advanced 56 points to 22,340. The Nasdaq was up 73. The S&P added 10. And the small-cap Russell 2000 index, it closed at a record. To the economy, where orders for long-lasting manufacturers' goods rose last month thanks primarily to a rebound in the volatile aircraft sector. Durable goods orders were up 1.7% and follows a sharp decline in July. Within that report, a closely watched gauge of business investment was higher for the second straight month, offering some hope that manufacturing activity is gaining strength. But a disappointing report on the nation's housing market once again. And that has a leading expert using some strong words about the future of home sales and values, and not in a good way. Diana Olick has more.
Principal, interest, taxes, and insurance.
Buyers signed fewer contracts to buy existing homes in August, and that was just the last in a string of sour housing reports for the month, with sales of newly built homes falling as well and prices skyrocketing. It led the Realtor's chief economist Lawrence Yun to a grave conclusion.
The housing market is stalling.
That's right, stalling, and not for lack of demand. Buyers are out there.
The buyers are looking to buy, but just not enough homes available for sale, so the contract signings are not occurring.
The supply of for-sale listings is down 10% overall compared to a year ago, and down 20% for listings priced under $200,000. That lower level is where demand is strongest, especially from millennials.
Millennials now, surprisingly, represent the biggest cohort of buyers. Millennials have spent over $500 billion buying real estate the last 12 months. That's the biggest of any generation. And so millennials are being forced to get creative because there's not that much inventory at their price points.
Zillow reports that about a third of millennials are not just using mortgages, but borrowing the down payment as well from friends or family. About a third are also going over budget to get into a home. Another telling sign, more than half of millennial buyers are now dual tracking their searches. That is, looking for both homes to buy and to rent, because they are not sure they'll be able to afford home ownership after all. For Nightly Business Report, I'm Diana Olick in Washington.
Let's turn now to Mark Wittner to talk more about the health of the housing market and what it might mean for the overall economy. He is the senior economist at Wells Fargo Securities. Nice to have you here tonight, Mark. Welcome.
Good to be back with you.
What's your response or reaction to Diana's report that maybe we do have a stalling housing market?
Well, I think that's exactly what we have, and it is because of supply concerns. I mean, there's just not enough homes out there for sale, and unfortunately, the hurricane hit two very large parts of the housing market, Houston and Southwest Florida, and that took more supply off the market.
What about the overall economic impact? If indeed we don't have enough homes to turn over, that means that we don't have enough homes to basically feed into that feeder chain of the economy, such as, you know, the Home Depots of the world if you want to renovate or if you want to add on. What's the overall economic impact and role of housing in the economy?
Well, housing has a huge multiplier. When you buy a home, an existing home, typically the person who's selling it is fixing it up, and then the person that buys it fixes it up. And then you've got all the furniture, you've got appliances, you've got services, you insure it, you finance it. There's a huge multiplier throughout the economy, and we're going to miss that. We're going to be lucky for single-family housing, existing home sales, to be flat in 2017 with where they were last year, which is pretty remarkable when you take into account that there's 10% fewer homes available for sale.
Are there other parts of the economy that are healthy enough to compensate for the lack of housing's contribution?
Well, one of the things that we saw today, we did get some good news on durable goods orders, and business-fixed investment seems to be coming back. Businesses are a little bit happier with the geopolitical environment. The regulatory environment's eased up a little bit, and that's a powerful offset. But housing's real important, particularly in the South, which is impacted by the storms, which accounts for over half of all home sales.
Wow. I didn't realize it was half of all home sales. How do you see that playing out then? I mean, rebuilding of new homes, there still obviously is a lot to still sort through. There's insurance claims. It's going to be a while. But how do you see that particular situation in the Houston area, in the southern part of Florida, resolving itself, and what could the economic impact ultimately be?
Well, 2018 will be a better year, but there's not going to be any rebuilding this year. I mean, one of the things that happens is when an area is declared a disaster area, even if a home isn't damaged, it's going to have to be re-inspected in order for it to be sold. So there's some pending sales that are likely to be drawn out a little bit, and then for homes that are damaged, they're going to have to be repaired. It's going to take some time. You've got insurance settlements, and so the supply of housing in Houston, and Houston's about 5% of home sales all by itself. It's a real big market, the #1 market for new home sales in the United States. And so and all of Houston is not offline, but enough of it is that it's going to be meaningful. And once you get past September, you really don't sell a whole lot of homes in October, November, and December. So 2017, this really kind of closes the door on 2017.
Mark, I think we're going to be talking to you quite a bit as this whole situation evolves. Thanks so much for joining us. Mark Wittner with Wells Fargo Securities. Still ahead, what happens if the stock market starts to head south? Are you prepared? The CEO of Marriott says his company is assessing the damage from Hurricane Maria and that hundreds of their guests are still trapped in their Puerto Rico hotels. Marriott, which has 16 properties and employs thousands of workers in the U.S. territory, says it's still too early to tell what the financial impact of that storm will be.
We've got associates that are trying to figure out how to get assets back up and running, and we've got some first responders and relief workers that are already coming and staying with us, even though they've been warned that there may not be things like air conditioning or some other things that they would typically find. I think it's going to be a long slog, is my guess, that we're going to see many months of work before the destination comes back to where it could be.
A week after that hurricane, nearly 3.5 million U.S. citizens in the territory are still without water, fuel, electricity, and other supplies. In recent days, the U.S. has ramped up its response to the island's humanitarian crisis. With stocks near record levels, some investors are growing concerned that a pullback is due. If you're in that camp, how should you prepare for a potential pullback? Well, Dominic Chu asked the pros.
With stocks continuing a trend of setting and hovering near record highs, it may seem somewhat odd to talk about a possible pullback in the market. But some Wall Street experts are looking to fine-tune client portfolios to protect against potential losses, or at least hold up better if things go south.
I think in this environment, you should have some cash reserves. Right now, we're overweight cash. However, we are still long risk-based assets.
There are lots of definitions for what makes a high-quality stock. According to stock strategist Christopher Harvey at Wells Fargo Securities, he's looking at how things like low levels of debt, as well as better trends in profits and margins, could define quality. That's among other things. He finds that they have tended to outperform on bigger down days so far this year. But a larger scale pullback may not be as close as some think.
Historically, in the fourth quarter, the market does pretty well, and I don't think this year is going to be different. Now, at this time of year, the market tends to trade off a little and bounce back kind of mid-October until mid-December, so maybe we won't have as powerful a rally. But I think the reality of the fact that next year the numbers are going to look pretty good to start is going to lead to a pretty good fourth quarter.
Top-ranked financial advisor Richard Saperstein of Hightower Treasury Partners believes there are other reasons to be more positive on the market, like rising earnings, a global economic recovery, and the potential for tax reform in the U.S. As a long-term investor, he'd be using pullbacks to selectively add to client portfolios. For Nightly Business Report, I'm Dominic Chu.
We are fast approaching, believe it or not, the end of the quarter. And a big question for investors is what kind of impact those quarterly reports will have on stocks. Bob Pisani takes a look.
The big debate is this. Are we at peak earnings? Earnings have been growing all year after growth declined in 2015 and 2016. That was a period that saw the markets move down. The question now, is that growth spurt over? The short answer, it doesn't appear to be. First, profits are still up, but at a slightly slower rate. Overall earnings for the S&P 500 are expected to grow 6.2% in the third quarter. That's a bit slower than we saw in the first half of the year. All right, why the slowdown? Some of the sectors that had big moves up are hitting tougher comparisons, principally energy and tech stocks. So, for example, energy bottomed in the second quarter of last year and had a huge boost in the second quarter of this year. Okay, but estimates for the fourth quarter and next year are still higher. In part, it's because the economy is continuing to grow. That's the most important thing. This year, analysts expect the S&P 500 stocks to earn 10% more than last year. For 2018, earnings are expected to grow an additional 7%. That's good news, but this growth does not have any tax cut assumptions in it because no one knows what they are. But today we're getting a little closer to an answer, so we can venture some guesses. The effective tax rate, what corporations really pay, is about 27% for the S&P 500. Each 1% cut in corporate tax generates roughly $2 in earnings. So let's assume that the rate goes down 4 percentage points to 23%. That would add $8 to earnings. So the 2018 estimates go to $148. That's a big boost, 6% more on top of the 7% expected without tax cuts. That's why the market keeps holding up. The combination of expected improvement in the economy and the tax cuts give indications that we are not yet at an earnings peak. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Ford and Lyft team up on driverless cars, and that's where we begin tonight's market focus. The automaker and ride-sharing service said that they would work together to develop self-driving software that allows Ford's vehicles to communicate with Lyft's smartphone app. Ford shares rose fractionally to $11.95. Another breach to tell you about, this time at fast food chain Sonic. The company said its payment processor identified a breach after noticing unusual activity on cards used at Sonic locations. Security news website Krebs on Security reported that the incident likely resulted in illegal underground sales of millions of credit card accounts. But still, shares of Sonic rose 1% to $24.89. Micron Technology reported results that were above Wall Street estimates and the company's guidance as well, citing strong demand for its memory and storage products. Micron also gave an upbeat outlook for 2018. The shares rose 8.5% to $37.09. And the uniform rental company Cintas reported a rise in sales and profits that topped estimates. The company credited the gains to an acquisition. Cintas also raised its outlook for 2018. The shares were higher by almost 6% to $144.01. Well, more fallout today from the NCAA men's basketball bribery scandal, and it was big. University of Louisville head coach Rick Pitino was put on unpaid administrative leave, but Pitino's attorney says the coach has been, quote, effectively fired. The school's athletic director was also put on paid leave, and the interim president of the university is not happy.
I would say that I was more angry than embarrassed. Obviously, embarrassment is part of it as well. But I think people who have watched what the University of Louisville has been busy doing in calendar year 2017 will understand that we have been working day and night, committed to make sure this place is a wonderful place for our students and our faculty and staff, and we're making a tremendous amount of progress. And when something like this happens, it makes me angry.
Eric Chemi is back with us with the big impact this could have on the university. Eric, it's great to see you as always. Thanks for rejoining us tonight. How big an impact do you think this will have on the university?
So you got to look at a lot of factors here. Just Coach Pitino, there's a reason why he's on leave and not fired technically, because he has a $50 million contract that he just signed in the last couple of years. So that goes on for many years to come. They may own $44 million as part of a buyout. So that's going to be one big chump change, let's call it. You know, they have to deal with that. That's why he hasn't been fired yet. That's $44 million. They have a $160 million sponsorship deal with Adidas that doesn't even start until next year. And so Adidas could just say, you know what, this isn't what we signed up for. We're not interested in a school with FBI allegations. They may pull out. So all of a sudden, if you don't have the coach and you don't have the sponsorship, this is a program that makes $100 million a year overall in sports. What does that do to the university budget? Now, the connection to Adidas, just explain to me again, it starts next year, so that's future revenue that this school would be losing if Adidas says, I'm going to pull out. So they have been an Adidas school for many years, but they did an extension in advance. They signed the extension a month ago, and it was going to start next year and run for 10 years at $16 million a year. So they're still an Adidas school. They renewed, but now what happens to that renewal? What about the future fallout, you know, recruiting athletes, things like that? Some of the students already today said, actually, we're not going to go to Louisville now that Coach Pitino's not there, because they were recruited. So they're high school seniors now. They would start next year. And they've said, you know what, we're going to reopen our recruiting process, but Louisville's not happening anymore. So if you lose these top-notch kids, who's watching the games, who's showing up on attendance, who's paying you for TV rights, all of a sudden that budget really starts to hurt. And it defines, does it not, the town to a certain extent, the city. I mean, lost revenue from people coming to the games. I would think that would have a big financial impact as well. Exactly. When you look at the biggest sponsorship deals right now, it's schools like UCLA, Texas, Ohio State, and Louisville. Louisville is not the same size as those other schools, so they may not be able to handle that much of a disruption to their revenues, because it's primarily known for its basketball program more than anything else, perhaps. Right. Eric, thank you so much. You got it, Sue. You're going to be back soon, I think, because this isn't over. It's a long story. It's a long story. Eric Chemi, thank you. Coming up, adventures in babysitting and how one entrepreneur turned it into a growing business. The city of Hartford's debt default is a virtual certainty, according to Standard & Poor's. The rating agency knocked down the city's bond rating for the second time in 2 weeks. The downgrade came after Hartford's mayor held a conference call with bondholders and suggested that he did not want to refinance the city's debt. Hartford needs at least $40 million in financial assistance from the legislature this fall, and without it, that city faces bankruptcy. From a big city
to small business. Well, business owners are attending the Iconic Conference presented by Inc. magazine and CNBC. That gathering is designed to help entrepreneurs network and share strategies. It also gives us a chance to find new startups that are working to put their ideas into action. Kate Rogers is in Santa Monica, California.
Every parent knows how hard it can be to find reliable childcare, especially on short notice. Helper is bringing experienced sitters to families in a pinch.
You can book a sitter the way you would book an Uber, but we have a lot of screening and you can get consistent babysitters through the app, so we call that continuity of care.
The startup was launched in early 2016 by Casey Edwards and Becca Klauber-Richter. The duo met at the University of California, Santa Barbara, where they launched their first childcare business, University Sitters. Today, Helper has 8,000 clients in Los Angeles and San Francisco and plans to expand into Chicago and New York this year. Sitter rates begin at $25 an hour, and the company works to fulfill on-demand requests.
Are you excited to play? Yeah. Me too.
Helper's 350 sitters also go through extensive vetting.
We do an interview process that includes an in-person interview. We check professional references, so we call parents, daycares, camps, wherever they may have worked in the past. And then we check for CPR certification, social media review, as well as a background check.
They're also working with a dozen companies, including Snap, to offer childcare services as a benefit to employees.
We're seeing not a lot of paid maternity leave, not a lot of paid sick leave, and so we're really trying to push culture into the space of supporting all of those working parent conditions.
Helper is hoping to get to the point where childcare is offered as a universal benefit across the country at companies large and small. For Nightly Business Report, I'm Kate Rogers in Santa Monica, California.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening, and we will see you right back here tomorrow.